Hello, everyone, and welcome back to our Wednesday workshop. We're going to give it a few seconds, let everyone go ahead and log in and jump on. Hope everyone's having a wonderful week so far. All right, so today we'll be talking about knowing your options, investing into real estate funds. So our guest speaker is going to be Jeff Rodriguez. I've gotten to know Jeff and Boost Capital, and I'll talk a little bit more about him. But before we do get started, just a few disclosures here. So what is NuView Trust? We are an alternative custodian. Our clients invest into alternative assets. We do not give tax or legal advice. So we always suggest you speak with your CPA or financial advisor and do your own due diligence before you make any investments. We custody different types of accounts like IRAs, education savings accounts, health savings accounts, and solo 401k plans. So what is a self-directed IRA? It gives you the ability to diversify your retirement portfolio and your investing into tax-deferred or even tax-free types of accounts that you can invest into alternative assets. So these are the plans that you can use to be able to make these investments. So you have your personal plans, your traditional IRA, your Roth IRA. The difference is how they are taxed. So if you want your strategy is to grow your investments tax deferred, you probably want to use a traditional IRA. What does tax deferred mean? It means you're not paying the taxes on the contributions that you're making now. You're paying the taxes when you take the money out after 59 and a half years old. When you take those distributions, it's based on whatever your tax bracket is at that time, and that is how that is taxed. You can only contribute up to $6,000 a year with a $1,000 catch-up contribution if you're over the age of 50. Now, this is the most common type of IRA. Why is that? Because most people have left employers at some point in their life, and they have a previous employer 401k, 403b, TSP, some type of employer plan, and usually it's pre-tax dollars in there. And then if they want to move it to an IRA, it would have to go in a pre-tax account. So it would go into a traditional IRA. Then you have your Roth IRA. So it's the other way around. The way the Roth IRA works is you make those contributions now. And when you make the contributions to the Roth IRA, it's going to grow tax exempt and you can take it out tax free after the age 59 and a half years old. So you're paying taxes on the contributions now. So would you rather pay the taxes on the seed or the crop? Well, that depends on you and what your strategy is when you're investing. Then you have employer plans. So anyone listening that's an entrepreneur, if you're self-employed, these plans you want to listen to. The solo 401k is a pretty powerful plan. You do have to be self-employed with no common law employees in any of your business entities. You can contribute up to $61,000 a year to this plan. You get to contribute as the employee and the employer because you play both roles. So as the employee, you can contribute $20,500. And if you're over the age of 50, there's an additional $6,500 you can contribute to that plan. And then there's an employer match. The employer can match up to 25% of your earned income. And that's how you can really maximize contributions to a solo 401k plan. A few other things about this plan that I like. If you invest into any types of deals, like any real estate, and you need a mortgage or there's some type of leverage involved, if you do this in an IRA, you're subject to a tax called the UDFI tax, unrelated debt financed income tax. But if you do that same thing with a solo QRP, what we call at NuView, or a solo 401k, well, it's exempt from that UDFI tax. Not only that, because it's a 401k plan, you're allowed to take a personal loan against it up to $50,000. It just cannot exceed more than 50% of the total value of that account. And you could pay it back over 5 years. So only 401k plans allow you to take that personal loan. You do pay it back with interest as well. So you're really just paying yourself back. Then you have your SEP IRA, also allows you to contribute up to $61,000 a year. However, that contribution is only the employer contribution. It's up to 25% of what your earned income is at the end of the year that can be contributed. So in order to maximize that, you have to have at least earned $244,000 at the end of the year, and then you can contribute that full amount. So for example, if you only earned $100,000 at the end of the year, then potentially $25,000 can be contributed to that plan. It's only 25% of your earned income. The simple IRA is great if you have a small business. You can contribute up to $14,000 a year. So it did go up a little bit. And there's a catch-up contribution of $3,000 if you're over the age of 50. If you do have employees, there's a mandatory match from the employer of 3% of that employee salary. So That's a potential way for you to, extend these types of alternative asset investments to your employees, and you could even partner on deals together if you wanted to do that. Then you have specialty plans. Most people don't know that these plans can be self-directed into these alternative investments. The first one's called an education savings account. So if you have kids or grandkids and you want to start saving for college for them, this is a great plan for that. It's only $2,000 you can contribute a year. It is not tax deductible, but it will grow tax exempt, and you can take it out only for school expenses tax free. So it could be used for tuition. It could be used for internet. It can be used for books. It can be used for anything that is school related. If there's uniforms required, anything like, say the student was in band or something and they needed instruments, you can use it for any education expenses. And then your health savings account. I love this plan. I have a health savings account. The reason I like this plan is because it's almost like the best of both worlds. The contributions you make to a health savings account is tax deductible going in, and then you can invest that money. It can grow, and when you take it out for any medical expenses, it comes out tax free. So if you're contributing just for yourself, the most you can contribute is $3,650 a year. And if you have a family plan, it's $7,300. So it's not as large as the employer plans. However, the power is really partnering multiple plans together to be able to make these investments. If you're over the age of 55, there's an additional $1,000 catch-up contribution. So these are the plans that can be self-directed into the alternative assets. The most common types of investments clients will make are things like private entities. So that could be things like syndications, sponsors, anything that's like a sponsored type of fund, limited partnerships, joint ventures, LLCs, trusts. I mean, the list goes on and on. So that falls under private entities. Then real estate. Clients love to own real estate in their IRA because it produces cash flow. And there's different strategies when it comes to real estate, probably things you're already doing now with your own money. But if you do it in an IRA, well, that's where the tax deferred or tax-free savings comes in. So you can buy foreclosures, tax liens, offshore real estate, option contracts, land, invest in commercial property, condos, short-term rentals. So the list goes on and on with real estate. And then some clients like to hold things like cryptocurrency, or they do private lending, or they might even buy existing notes, mortgage notes. So I'm going to go a little bit on the notes here. You can invest in secured notes or unsecured notes. The difference is if it's secured, then that, just like a bank, you go to a bank and get a loan. Well, our clients use their IRAs to loan to whoever the borrower is, and it's secured by the real estate. So just like a bank, if you don't pay the bank back, they foreclose on the property. Well, the clients can do the same thing with their IRA, and then their IRA would end up owning the property rather than the note. So that is a strategy some clients like to use. An unsecured note means it is not secured. There's no collateral on the line, but you can charge higher interest rates. So that's up to you to discuss with whoever your financial advisor is before you make any investments. All right. So I'm really excited to bring Jeff Rodriguez on. He is with Boost Capital. He's been in the real estate business over 10 years, and they've invested in over 2,400 apartment units. And I think he has some great pointers for you if you're looking to invest into any type of funds or multifamily. Jeff, how are you today?
I'm excellent. Thank you for having me. I hope you can hear me really well. There's quite a bit of an echo right now.
Audio is great. How's the weather where you're at?
It's great. It's I think it's about low 80s, so it's not too bad. Can't complain. Could be worse.
Awesome. Well, I'm gonna let you go ahead and take over from here. I'll meet you at the end of the presentation for the Q&A. Okay.
Excellent. All right. Thank you. Thank you so much. All right. So thanks, Brian, and thanks for everyone attending. So I'm Jeff Rodriguez. I'm co-founder of Boost Capital Group. We are a private real estate investment firm and a provider of investment opportunities, risk mitigation, and portfolio diversification through alternative assets. We work with high net worth individuals, busy professionals, provide them passive investment opportunities into real estate and helping them preserve and boost their capital. As he stated, we're invested in over 2,400 units across multiple states, and we have been investing in alternative assets for over a decade now. Let me go over this quick disclaimer. So Boost Capital Group does not provide tax or legal advice. The material here is provided for informational purposes only and should not be construed as investment advice or an offer or solicitation to buy and sell securities. All right, now we got that out of the way. So we've covered who Boost Capital Group is. I'll cover our philosophy. So we believe that busy professionals like you should not have to compromise between spending family quality time and securing their financial future. Therefore, we work for you to help find profitable investment opportunities in real estate so that you can continue spending time with your family and being the professional that you are. Now, before we dig into what a real estate fund is, I want to touch base on what a fund is. So basic of a fund is it's an investment vehicle where investors put their resources together in order to invest in securities. And securities that you're familiar with are stocks, bonds, commodities, which create mutual funds, and real estate and crypto. Now, what is a real estate fund? All right, so same thing, same basics of a fund. It's specifically tailored towards real estate investing. What type of assets you would find in a real estate fund can be residential, land, commercial, and commercial is broken down into office spaces, industrial, such as an Amazon warehouse or a big center for like data centers, multifamily apartment complexes, and retail. You also have mixed use, which are retail with some multifamily condos. So there's different variables that go in within commercial real estate. Benefits. So why invest in a real estate fund? So forced appreciation, meaning that you lower the expenses, increase income by applying different metrics. Diversification, because you're investing into a fund, there's multiple assets within a fund. So therefore diversifying your capital among multiple assets and multiple areas. And recession resistance, why is that? Everybody needs food and shelter. There is a deficit of housing right now in the United States. And there's always going to be someone's always going to need somewhere to live. So that's why we consider real estate a recession resistant asset. Leverage, not only do you leverage the capital that you're pulling into through the fund, but you also leverage the expertise and the time of a team of dedicated professionals that are managing the fund. As far as tax benefits, you get tax benefits because you have equity into the deals, and you get access to larger deals as a result of pulling your capital through a fund. Now, options of investing into a fund. There are different flavors of funds. Some may not be called funds, but they're still the same process. So real estate investment trust, which most people are familiar with, REITs. You have syndications, where less people are familiar with syndication. Real estate equity fund, and then our CPREF, which is a customizable private real estate fund that's fairly new to the space. And we'll slightly touch on these. We're gonna do an overview of all these. First, we're gonna go over a real estate investment trust. So a high level, you can find them as public or private. They are created similar to a mutual fund. Private REITs, you can buy shares like stocks from on publicly traded REITs. Private, not so much. Private, you need to find a broker or someone that has connection to be able to get you into a private REIT because they're not publicly traded like stock. They manage large real estate portfolios. They could either own the real estate, they operate the real estate, or they could invest capital into a deal by financing the asset. 90% of the taxable income from a REIT is distributed as dividend, and that's by requirement. However, the depreciation is considered into the dividend. Therefore, the tax benefit is achieved before before you see it as the investor. So it's you don't really get much tax benefit from a REIT. And the typical returns are 5 to 6 for public and 7 to 9 for private, and we included a source of that information right there in parentheses. Considerations. So because most of these distributions, the dividend distributions, are non-qualified, meaning they are taxed as ordinary income, therefore leaving a lot of the tax benefits on the table for where you can find in other asset classes. They typically have a higher management fee as well, and we included a source, which is investor.gov. It's a Securities and Exchange Commission website, and they're easier to get in and out because they are acquired through purchase of like shares, right? And these are for publicly traded REITs. There's a lower minimum, lower barrier of entry, because again, they're like sold like shares on public traded REITs, and they do have the same or similar volatility to the stock market. So it's in line with the gains and losses that you will see in the stock market. Now we talk about syndication, which is not known as wide as REITs. So high level investors also pool their resources to acquire large assets or small portfolios. In syndications, you invest in deal by deal, and you invest with the general partner. So the individual that goes out, finds the properties, underwrites the properties, gets funding, and just pretty much does all the work. You are brought in as a limited partner, and you own equity into the deal. There's SEC oversight, Securities and Exchange Commission. And so it requires an SEC lawyer to draw up the PPM, which is a private placement memorandum. It's almost like considering like a business plan. You also get a subscription agreement of what the agreement between you and the sponsor is. You get an investor portal where you access all these documentation, as well as tax documents in the form of K1, which provides your profit and loss statements. Typical returns are targeted to 15 to 17% IRR, which is about for a 5-year hold is about 2 times you double your investment in 5 years. Considerations. So you're investing passively into these specific deals. So one deal, you're passive into that deal as a limited partner. Now you perform due diligence per deal. So for every deal you get, you're performing due diligence on the sponsor, the deal, the market of where that deal is located. You review the business plan, the PPMs, review underwriting. So everything that you would do in order to perform your proper due diligence per deal. Now, because it's deal by deal situation, there's lack of diversification. So unlike a fund where there's multiple assets in there, a syndication is a deal by deal situation. So the diversification there is limited. The minimum on average is $75,000 to buy into a syndication, and normally it's a 3 to 5 year hold. Therefore, the 15% giving you a 2 equity multiple. A real estate equity fund. So it's a partnership established to raise equity for ongoing real estate investments. So an overview of the fund is you're committed to the fund criteria, not specific deal. Unlike a syndication where it's based on the deal's criteria, when you're committed to a fund, you're operating off of those fund criteria as an investor. The diversification is better than the syndication because you're invested in multiple assets. You benefit from pass-through depreciation because you have equity into these deals as well. And we consider this a one-stop shop. So because you're part of a fund, you get access to multiple deals. You also get your PPM and subscription agreement as you do in a syndication. You have an investor portal, and you get your tax documentation all in one-stop shop in a fund. And the typical returns are similar to a syndication, which are 15 to 17% IRR. Now, because you're committed to the investment fund criteria, let's remember that for a second, because I'm going to come back to that. Now, because you're committed to the criteria, the flexibility is not as it's not available as much. So if the PPM requires the fund to invest in 50% office buildings, 25% multifamily, and 25% hospitality, we look at the current situation with what happened with COVID. A lot of office spaces were vacated due to government mandate. Therefore, there was a lot of loss of income there, as well as hospitality. Hospitality took a big hit during the COVID situation, and they are recovering now. However, the fund, your capital would have took a hit. So you may be locked into the fund criteria even during a market shift. So those are things to consider. There's a lack of deal selection. So when investing into an equity fund, real estate fund, you don't select the deals you invest in. So if you don't share the same market outlook of a specific location and you do not want to invest into that, that's part of the fund. So you necessarily do not select what deals you're invested in. It's all within the fund. So therefore, there's low transparency in regards to the individual deal's performance because the returns are blended. So if you have a higher performing property and then you have a lower performing, the returns are averaged and therefore blended, therefore giving you your pretty much overall returns. The hold period depends on the fund cycle. So during the fund, you can be locked in for 10 years because most funds would be operating for about 10 years. You got the capital raising time, the investment time, and then the harvesting period, which would be selling of assets in order to be able to close out the fund. So that could actually last up to 15 years, depending on the fund cycle, the assets acquired, and things of that nature. And also the market, if they have to hold the assets longer, they may request an extension to hold the fund a little bit longer, just to kind of base it off the market, the current situation of the market. Now, here we have the CPREF, Customizable Private Real Estate Fund. So high level, so you get the benefits of a fund and the flexibility of a syndication, specific deal selection. So you can pretty much identify, you have multiple assets in multiple markets. You own equity into the deal as well, and you get the tax benefits such as accelerated depreciation. And these are performed on per asset situation. So you have a cost segregation study that's performed on a property, and within the first couple of years, you get that depreciation on the assets. You also a one-stop shop. You get PPM, subscription agreement, just like a fund and a syndication. You get your investor portal and your tax documents for all the assets you are invested in. Instead of tracking down multiple K1s for different syndications, you get all your investments in one K1, one tax document for your tax professional or CPA to add to your taxes. Typical returns are targeted at 17% IRR. Now, one thing to consider is that these assets, because it's deal by deal selection, as stated in the last point there, most of the assets are going to be targeted at those returns. So these returns are not blended. So it's a better opportunity to pick what assets you want to invest in, therefore increasing your returns versus a blended return from a regular real estate fund. So considerations: minimum investment of $50,000 and 3 to 5 year hold per deal. So not the time frame the fund is open, but this is based on a per deal basis. There's administrative management fees, just like the other fund. you get to create a portfolio within the fund. So because due to deal selection, you get to pick what assets you're comfortable with, what markets you share the same outlook with. So if there's a market that you do not like, you do not invest into that. So therefore, it allows you to create a portfolio within the fund, and therefore increases your diversification. You have more control and more flexibility. And the returns are typically better because instead of investing directly into a syndication at, say, $75,000, if you invest through a fund, which is the pool of capital that's going to a syndication, there's sometimes better returns, higher returns for, let's say, $500,000 investment. But because you only have $75,000 to invest, your capital is pooled, therefore allowing you to get the higher echelon of returns by pulling your capital into this type of fund. And the distributions are made to investors first on a CPREF. Now, here's a comparison, not necessarily a pros and cons, but just like a quick overview of the positive or the negatives that you would see from investing in these type of assets. Not all assets fit everybody's investment criteria or investment plan, but this is just kind of gives you a quick overview of what would fit your investment plan or criteria. So these are the type of assets that you can find in the real estate fund: core, core plus, value add, and opportunistic. And we'll dive in a little bit deeper on these. So core plus is pretty much the cream of the crop per se. They usually have a lot less leverage. So if there's something in the market, let's say there's a lot of vacancies take place, because there's little leverage, you should be fine. But when there's a lot more leverage, there is a lot less cash flow. So that's why these are preferred risk type of investments. They're more stable. They have investment grade tenants. They have long leases, and they're better construction overall. They're in large MSAs, large markets, and most of these returns will come from the property's cash flow rather than appreciation, because these are top core properties. Then you have core plus, a slight step down of the core properties. So these properties are in good locations. They could be in great locations as well. They are dependable revenue. They high quality tenants as well. They are slightly have dated finish, so you need some capital expenditure in order to bring them up to par. The vacancy is rather low, and the leverage is not as low as a core, but it's just a little bit more leverage. It's still good. It's still a good investment, obviously, and the returns will pretty much, the cash flow would generate from the tenant base, and then you also have allocated capital for future deferred maintenance in the form of capital expenditure, which is part of the business plan that you would see. Next, we have value add. Value add is what you will probably see more often in a lot of these funds, these real estate funds. They're in good locations. They also have dated finishes. So value add, consider it like a big time flip. So you have a small house where you do your flip, you repair, you pretty much make it better, and then you sell it. The value add is kind of that idea. You improve it through capital expenses, where you improve the property itself, you bring it up to market standards, you attract new tenants at market rates. So if, say, the property has low rents, and you fix up the property and you bring it up to market rates, they require a little bit more leverage as well. And the returns, there's little cash flow when you first acquire it because of poor management or just low rents. You do the value add, and then it generates better cash flow once you implemented value add through lowering expenses and increasing income. And lastly, we have the opportunistic option, which this is a huge repositioning. There's high vacancy, there's a lot of repairs, and needs a lot of leverage. So it's a lot of work required in these properties. They're a lot more risky, but the upside for profit is also high as well. So there's with these properties, there's little to no cash flow when you acquire them, but it has a potential to produce a lot of cash flow, value add, and a large return when they're sold. So that's pretty much in a nutshell, quick overview of the type of assets you would find in a real estate fund, the types of real estate funds and different options you may have access to. So if you want to learn more, please reach out. Let's connect. My email address is right there. There's our website, boostmycapital.com. And you could also scan this QR code, which take you directly to our website. And if you have any questions, you want to get on the phone call, need a little bit more granularity on what we presented, feel free to reach out at info@boostmycapital.com. Check out our Facebook, LinkedIn, and we have also some informational videos on our YouTube channel. So thank you, and look forward to connecting with you.
All right. Thank you so much, Jeff. So we're going to go ahead and open it up for Q&A. So anyone, if you have questions, go and type those in the Q&A section. I will read them off for you. So what markets do you guys typically focus on?
Sure. So the better markets are anywhere in the Sun Belt area. So anything south from Arizona, Texas, all the way to Florida. We focus a lot in the Southeast corridor. So the Carolinas, Georgia, where we have some assets in Texas and Arizona. But those are pretty much the predominantly the areas. The main focus is the large markets, the large MSAs, 500,000 or above population.
Yeah, that's definitely I hear across the board a lot of people looking in the same markets. With all the people that are scooping up this multifamily, deals here, I think, people can diversify when they're looking at funds versus going to the individual syndications, correct?
Correct, right. So because the fund allows you, especially like the CPREF, so Boost Capital, we have the Boost Wealth Fund, which is a customizable a la carte fund per se. So it allows you to, pick which assets you want to be invested in. If you don't like a market in the north, say New Jersey or something like that, you don't have to invest in that. We don't necessarily invest in New Jersey, but that was just an example. Yeah. So diversifying your portfolio like that does help with, one time, not having to look at multiple areas, multiple sponsors. It allows you to have, access to multiple deals because you will become part of the investment club. You get access to all these deals because you've been vetted. If you're an accredited investor, you don't have to continue submitting your accreditation letter to multiple sponsors. You could just kind of, in a fund, you submit it one time and you have access to any and all deals. It's just up to any investor to pretty much do their due diligence, which is always recommended. We try to be as transparent as possible, which is important to building the relationship.
Yeah, definitely. That makes sense. I don't see any questions coming in, but if anybody wants to reach you, we have your website right there. Go ahead and scan that QR code. Jeff's a great resource, can definitely answer some questions. This is a little different from, investing in specific syndications, like Jeff was explaining. You're investing into the fund. Does your fund allow for any non-accredited investors as well? So the Boost Wealth Fund is a 506c, so it's only for accredited investors right now. There are other opportunities that we have that are for non-accredited investors, and that's something we could talk about
if they reach out, we could talk about that offline and kind of give more granularity on what that looks like.
Okay, perfect. All right, everyone. Well, if you have questions about opening a self-directed IRA, the best way to reach us is IRA specialists at NuViewTrust.com. We can set up a one-on-one consultation if you do have any questions. Oh, I did get one question come in for you, Jeff. How long has your fund existed?
Yeah, so we've invested longer than the fund been around. So our fund was created in May of this year. We have a portfolio in there at the moment and looking to add more assets for investors to be able to diversify within the fund, but it's been around since around May.
Okay. I did have another question. How do you become an accredited investor?
Sure. So we do have informational documents that will allow you to kind of overview what you qualify, but it's a qualification process. It's based on the it's based on income and or assets. So if you are a single individual, you have to make $200,000 a year or have $1 million of assets, not including your primary residence. Or if you're married, that's $300,000 a year of income and $1 million of assets, not including your primary resident. We do have a video, and we also have a worksheet that you could just punch in all your assets, your income, and it pretty much will calculate everything for you. There's a lot of things that people don't consider, such as their from their cars to gold to just there are different things that you can add. Even what is it? There's a lot of things. It's just listed on that document we have, and it's on our YouTube video, and it has linked to that document.
Yeah, so it really, yeah, exactly. It comes down to how much income do you earn, and if you're married, your spouse, it's included as well. That could help. I think it is $200,000. They might have increased it, and then it has to be a certain amount of years you've earned that income, or you have to have at least $1 million worth of assets.
Right.
If somebody invests into a fund, is it subject to UBIT tax? Do you know the answer to that?
So we will defer to you talk to your CPA about it, because everybody's situation is different. So we don't, that's something we could discuss depending on your situation. But we usually defer to your CPA.
Yeah. So typically, if you're investing into a business, it's going to trigger UBIT. But if you're investing into anything that involves a leverage portion, some borrowed money, a mortgage, like I mentioned in the beginning, solo 401ks are exempt from the UDFI tax. So typically with like a syndication, there's leverage involved. If you're qualified for the solo 401k, then you might want to consider using that type of a plan to make the investment, and then you're exempt from that UDFI tax. Is there any leverage or debt in your fund? I would assume yes, correct?
So there is, depending on the asset. Some of the deals, because they're individual deals, most of them there is leverage involved, yes, because it's a deal by deal situation. So when we add these assets, there is leverage involved. That's why it allows you to kind of invest into the specific deals within the fund.
Yeah, these are great questions. Definitely, if you want to connect with Jeff one-on-one, you can talk to him, or you can reach out to me. Just email me, IRA specialist at NuViewTrust.com. See if you're qualified for the solo 401k. I can help you from there. There's also a link in the chat if you want to click that. There's an additional YouTube video you can watch. If there aren't any other questions, I'm going to go ahead and wrap it up. Hope everyone enjoys the rest of their week. You can stay up to date with NuView and anything that we have going on, events or classes. Just scan that QR code. You can follow all of our recordings on YouTube. Please follow us on Facebook. LinkedIn's a great place to find me personally. My name is Brian. My last name is Martinez. I like to share content from, people that have sent clients to NuView and have a great relationship with us. And there's always great relevant information from people doing all kinds of different types of investments, from self-storage, syndications, multifamily, mobile home park, short-term rentals. So I try to share as much content as I can. Thanks everyone for joining us today, and we will see you next Wednesday at 1 p.m.